Hello all and welcome to our Fireside Chat series, Stable Value Strategies, Navigating Uncertainty with Confidence with Lincoln Financial. I'm David Braham, Executive Director of Content and Institutional Investor. And I have with me today, Jayson Bronchetti, Lincoln Financial's Chief Investment Officer. Jayson, thank you for joining us.
Thanks for having me, David. It's great to be here.
The markets have certainly had their fair share of volatility and uncertainty this year. But what's the outlook? What lies ahead? Jayson, now that we're in the back half of the year, what's your take on the market landscape? And what are the trends or themes that you expect to drive the economy and market moving forward?
Yeah, well, this is a really interesting topic to dive into. So despite the ongoing uncertainty, the first half of 2025 delivered one of the most remarkable recoveries for stocks really in recent memory. And as you know, during the first half of the year, we experienced trade tensions and deficit concerns and what felt like a real recession threat in April. Yet by the end of June, U.S. equities defied expectations and surged higher. And here's why I say that recovery was so remarkable. 2025 was only the third time since 1950 that the S&P dropped by 15% or more in the first half and still finished June with a year-to-date gain. And the other times were really just 1980 and in 2009. And I think there's been a bit of a whiplash for financial professionals and investors. But one thing has rung true. Amid this uncertainty, markets have continued to prove their resilience. And I think there's a few key drivers of this resilience that are notable and probably worth calling out. And the first, between low unemployment levels and manageable inflation, the economy is still on pretty solid ground. Second, corporations continue to adapt as earning strength and robust capital expenditure plans really reflect a remarkable level of resilience. And then the third, investors still have confidence in the markets and retail demand remains strong. And at the same time, tight credit spreads indicate sustained and measured optimism from the institutional investor community as well. So we are continually encouraged by the resiliency the market has shown to date. And we do think it will be an undercurrent that runs deep through the rest of the year. At Lincoln, we recently updated our third quarter market intel exchange, which for this audience to know is a comprehensive chart book. It's really a report that dives into market and economic analysis and takes a look at trending themes that could impact portfolio decisions. So I'd encourage financial professionals to head to our website and subscribe as we release new intelligence every quarter. And within our latest edition, there are a few core themes that we will keep a really close eye on throughout the year and year end and beyond. And I'll just name two. First, of course, is tariffs. And I think tariffs will likely stay in the headlines. Despite the fact that tariff levels are settling in significantly higher than they were coming into 2025, the flurry of trade deals in recent weeks has provided some much needed certainty to markets. And, markets have largely shrugged off the tariff news for several months now. And the latest developments were really no exception. And I think there are three primary reasons for that. First, expectations management. Markets went from expecting 10% tariffs to upward of 25+% tariffs in an instant back on April 2nd. And with more time to digest, today's levels represent, much less of a shock to investors, even if they only represent a kind of a minor de-escalation versus the April levels. The second thing is that the administration's sensitivity to markets has become a little bit more clear. When we saw market weakness after Liberation Day, that policy shifted quickly. And so this reinforced the belief that severe market stress will trigger policy moderation by the administration. And then the third, nearly everyone expected tariffs to meaningfully impact the economic data by now, especially inflation. But they really haven't. I mean, there's still time here, and I still think it's a little premature to take a victory lap on inflation because I think that may take a little bit more time to play out. But nonetheless, I think tariffs will remain a hot button issue over the coming months, but these recent trade agreements may help many businesses move forward with implementation clarity. And American companies have already shown agility and adaptability to change, and there's no reason to think that can't continue. Another driver, I think, of the market uncertainty for the rest of the year is around the tax provisions and what that means from a fiscal perspective. What are the implications from a fiscal perspective? And the fiscal implications of recent policy developments, particularly the extension of the Tax Cuts and Jobs Act, create both opportunities and challenges for long-term portfolio construction. On one hand, I think legislation offers greater policy clarity and removes the near-term uncertainty tied to the tax relief expiration risk that have been out there. On the other hand, it does raise concerns about fiscal sustainability and factors that could influence interest rates, investor sentiment, global investment flows. And the national debt will continue to be another hot topic, but it's likely to be more of a long-term structural issue than an immediate crisis. But amid all of this, uncertainty does come opportunity. And so we track economic policy uncertainty through an index published by the St. Louis Fed that measures everything from disagreement amongst economists to news coverage. And this year, we're seeing some of the highest levels of uncertainty since the inception of the index in 1990. But here's the key insight. Forward returns for the S&P 500 from periods of high uncertainty were significantly higher, and in most cases, double the returns from all periods over the next 1, 3, 6, and 12 months. And I say all this to remind viewers that amid ongoing policy uncertainty, it often is a precursor to some of the best times to be invested. And we've seen some of that. So just to wrap on the outlook, the market has been resilient, even when challenged by ever-evolving policy decisions. So consider staying diversified, both domestic and international. Focus on what policymakers do, not what they say. And then keep in mind that historically, periods of elevated volatility and elevated policy uncertainty have often coincided with strong market returns.
Thank you, Jayson. You heard the message clear. With uncertainty comes opportunity. So thank you very much, and thank you for watching. Make sure you tune in to the next and final installment of our Fireside Chat series, Stable Value Strategies Navigating Uncertainty with Confidence with Lincoln Financial. Thank you and take care.